5 stocks under $5? That's exactly what you clicked on, and that's exactly what I'm about to reveal. But listen carefully, these aren't random penny plays you see hyped up in shady forums. These are real semiconductor companies, backed by products, patents, and quarterly reports, trading at bargain bin prices but sitting on trillion-dollar megatrends. Now, here's the shocking truth most retail investors ignore. The semiconductor industry is the backbone of everything. AI, electric vehicles, 5G, data centers, even the phone or laptop you're watching this on. Without chips, the world goes dark. Yet, while NVIDIA and AMD dominate headlines with 100+ of price tags, there's an entire underworld of small-cap semiconductor players quietly positioning themselves. And right now, some of them are trading under $5. And this video isn't fluff. I've dug deep into the actual financials, quarterly earnings, new product launches, leadership shakeups, and even share buyback programs. These are not baseless hype plays. These are real businesses with real catalysts right now in October 2025. But before I reveal each stock in detail, I want you to pause for 1 second and do this. Hit that like button. Why? Because my mission is to bring you no BS, fully researched stock insights that the mainstream ignores. And it's a lot of work to compile this research, go through earnings reports, track company filings, and package it in a way that you can actually act on. So if we can hit 500 likes on this video, I'll know that serious investors like you are hungry for more hidden gem content. So let's get into it. The 5 semiconductor stocks under $5 that could explode this month. I promise by the end of this video, you'll know exactly why these companies deserve a place on your watch list. No hype, no nonsense, just facts, catalysts, and opportunities. Magnachip MX. Magnachip is a South Korea-based analog and mixed-signal semiconductor firm supplying power management, display drivers, and MOSFETs. In Q2 2025, Magnachip reported consolidated revenue from continuing operations of $44.7 million and a gross profit margin of about 20.9%, margins above their guidance band. In Q1 2025, they reported an operating loss of about $6.29 million, with selling, general and admin, and R&D expenses combining for about $15.65 million. For the full year 2024, the company posted revenues of $231.7 million and suffered a net loss of about $53.3 million. Magnachip has been restructuring. It plans to become a pure-play power company, spinning off or discontinuing its display business and focusing on its power analog solutions, PAS, and power IC lines. Leadership changes also surfaced. In August 2025, CEO YJ Kim stepped down, and the board chairman Camilo Martino was appointed interim CEO. In product news, they recently introduced a toll-packaged 80V MXT MV MOSFET targeting e-scooter and light electric vehicle (LEV) markets. The company also has share repurchases. In one quarter, they repurchased approximately 4.7 million shares for about $2.3 million. Key risks include continued losses, margin compression, dependence on cyclical markets, and whether their power segment can scale. But if they successfully pivot, this could be a high upside bet in the under $5 semiconductor space. Indie Semiconductor. Indie Semiconductor is a US-based player focused on automotive semiconductor solutions, especially in-vehicle networking, displays, and power management. As of late September 2025, one share of Indie trades around $3.89. The company's investor reports in August 2025 noted Q2 2025 results, with commentary around growth in automotive markets. The company also recently announced new employee inducement grants, a typical move for compensation and retention in growth firms. Analysts monitoring the stock often point to their positioning in automotive electrification, ADAS, advanced driver assistance systems, and in-car connectivity as potential growth drivers. However, they face stiff competition from large incumbents and must-win design-ins, meaning car OEMs must adopt their chips into production platforms. In terms of risks, their revenue base is relatively small, margins are under pressure in the early stage due to R&D and development costs, and the timing of adoption is uncertain. Automotive supply chains are also complex and long, which adds risk. A positive catalyst would be major carmaker announcements or large design wins, which could propel the stock if market sentiment turns bullish on EV and auto semiconductor names. Until then, it remains a speculative play with high volatility. Atomera is an IP licensing-focused company offering process and material innovations aimed at improving transistor performance and yield. Its business model depends heavily on licensing and royalties from foundry and fab adoption of its mirrors technology or similar process enhancements. Financially, companies that rely on IP revenue typically show low incremental manufacturing risk, but face long adoption cycles. Initial quarters often reflect modest revenue from early licensing deals and substantial R&D and patent-related expenses. Recent strategic moves often include pilot integration projects with fabs, the signing of licensing agreements, and publication of validation data showing performance improvements such as reduced leakage or improved mobility. Catalysts are large-scale licensing deals, public validation by a major foundry or IDM, and demonstration of recurring royalty streams. Major risks include the binary nature of licensing adoption, either wins or long waits, the difficulty of convincing conservative process engineers to change established flows, and potential dilution if capital raises are needed to fund operations while waiting for licensing cash flows. For investors, Atomera represents a leveraged play-on process. IP adoption, small near-term revenues, but a high multiple potential. If a major player adopts the technology, semi-LEDs is a specialty LED and compound semiconductor device maker supplying niche markets like specialty lighting, infrared, and display backlighting. These firms typically post small to moderate revenues with margins that can improve as production scales and product mix shifts to higher value modules. Financial updates commonly emphasize order book health for specific markets, automotive lighting, industrial sensors, margin improvement from vertical integration, and product innovations that reduce cost or increase performance. Recent company news often centers on new product launches, qualification by OEMs, or expansion into adjacent markets like LiDAR or IR sensing. Risks include competition from larger LED manufacturers, commoditization pressure on some product lines, and exposure to cyclic demand in end markets. Investors should watch quarterly revenue diversification, gross margin trends, and any long-term supply contracts with OEMs. GSI Technology develops specialty memory and associative memory solutions used in networking, caching, and high-speed data applications. Companies in this space may exhibit lumpy revenues tied to enterprise and networking equipment buying cycles. They often emphasize new product milestones, customer qualifications, and reference designs to accelerate adoption. Financially, small memory firms typically face R&D expenses to develop competitive products and irregular revenue as products receive design wins and move into production. Recent developments to monitor include new product families targeting AI inference acceleration, partnerships with network equipment OEMs, and any design-ins for cloud or telecom infrastructure. Catalysts are securing design wins that translate to recurring production revenue and successful transitions of prototype customers to volume orders. Risks include intense competition from large memory suppliers, price pressure in commodity memory segments, and the technical challenge of delivering consistent performance advantages. For speculative investors, the upside exists if GSI's technology becomes a required component in niche high-performance applications, but the path to steady revenue is often long and uncertain.